This is our Forex blog for April 23rd, 2012. I've added something new to our currency meter today, and it's totally up to you whether you want to add this to yours or not. But if you right-click on the chart, you can see I have added the FX Power Index, which basically tells us what percentage of all the currencies are above or below these moving averages. 15-minute bars, 20-period moving average. And the new option is draw color strip thin, which makes this 8 pixels wide instead of 10, and it doesn't have the labeling over here on the right, which prevented us from making it smaller like this. And then the second one is what percentage of currencies are above or below their hourly moving average. This is very critical on the Forex markets. Hourly is one of the most popular time frame charts. You know, most heavy, big Forex traders use hourly 20-period moving averages as major support resistance and as a filter. So these show up on the top, and I also put a little spacer between the top part and the bottom. And so if you're new to watching this, what we're doing is statistically comparing every currency to every other one. We got the dollar and the yen on the top, which most people trade against the bottom pairs, and the histogram on the top is an average of 5 different statistical tools we've perfected over the last 6 years of trading Forex. 3 of them measure the percentage of currencies going up and down, and the other 2 measure the intensity of the trend. So anytime it's at or above the 80 level, you have the majority of dollar pairs going up in this case today, and yen pairs are even stronger, and they're going up with incredible intensity. The yen has much more intensity than the dollar does. Underneath that, what percentage of currencies are above their 15-minute bar 20-period average? Underneath that is the hourly, what percentage. So you can see the dollar and the yen both have real-time strength. The percentage of currencies trending up is very high in both cases. The yen is obviously stronger than the dollar. And underneath that we have a daily, weekly, and monthly trend. So before, the reason I've added these 2 new trend identification filters on here is because it's possible that the daily trend's down, the weekly trend's down, the monthly trend's down, but the real-time trend is up, and it might go up for 3 or 5 hours before the daily trend shifts up. And so now you can spot that on your chart immediately. Plus, this particular currency meter only works live because we statistically compare all the different time frames to each other, and you know, it's also being put on a range chart, which the more bars there are, the more granularity you have to this. And so it's impossible to have this work on past bars and have it be accurate, so we don't even attempt to do something that's, you know, silly and impossible. So on days where maybe the daily, weekly, monthly trend's down, but it starts off having a lot of strength, the 15-minute trend shifts up, then the hourly, then the daily, then the weekly, then the monthly. That's what typically happens in the reverse from shifting from an uptrend to downtrend. So now you can take trades that you might have been afraid to take in the past. For instance, you can see starting the day off, the 15-minute, the hourly trend, the daily, weekly, monthly was down in the dollar. This one shifted up first, then this, then the daily, and the weekly kind of shifted up too, mainly because of where it was in its range. And then last but not least, the monthly trend shifted up at 3. And that's what typically happens. And so now, if you see the real-time trend going up and the 15 going dark green, you can buy those opportunities. And basically what we want to do, and it's real simple, is buy the strongest versus the weak. The dollar and the yen are the 2 strongest on the top. The pound is also strongest. We have a moderately weak euro. Swiss is pretty weak. Notice that the daily, weekly trend were up, but the new 15 and hourly trend were down, and so the real-time trend was down too, so you can sell those if you choose. You know, obviously everyone tells you to trade with a trend. Well, what trend? The real-time trend can be down, the 15 and hourly trend could be down, but the daily trend could be up, the weekly trend could be up, and the monthly trend's down. So you got to decide what time frame trader you are. Myself, I like to hold trades anywhere from 10 minutes and usually no longer than an hour and a half. I will tend to scale out of trades, usually be out of the first half in 20 or 30 minutes, and I don't like to hold trades more than an hour and a half. So I will focus myself more on the real-time trend, the hourly, and the 15-minute. I also want the daily and the weekly to be in my direction whenever possible. You know, for instance, the dollar and the yen and the pound pretty much up on all time frames. In New Zealand and the Australian are the weakest. So you want to sell the Australian dollar. That's one of the most likely to go down currencies. And you can see it fell last night, coming up to midnight, fell down. If you look to sell here, you probably had a loss. If you look to sell here when the trailing stop got hit, 84.15, you're short. Had you out right here at 75. That's a 40 pip win. And it's up to you whether you want to sell it underneath the lower white band, but typically you get a reversal underneath there, and almost always a reversal underneath the 3.0 containment band, which I label green. So if you shorted this again, this is a good place to get out, and it's also a good place to look for counter trend trades, no matter how weak the currency is. Very few currencies go and stay underneath the 3.0 band. And in fact, this is one of the systems that I've automated with my own trading because it is very predictive in calling for a reversal. You also want to sell the Australian dollar, and you can see last night fell, pullback, and most of us would rather use range charts. Let me show you what it looks like in a range chart. You'd be short right here at 37, out at 17, 20 pip win. Short here, it looks like you probably lost 5 or 6 pips. Short here at 08. Notice where it went to, the 3.0 band, the green band, like I just said. It is a reversal area. So if you don't have it on your chart and you're short and you're hanging on for more pips, you might be up 10, 15, even if you're up 5 pips and it hits this band, you better consider getting out. Not getting out means, you're being greedy, and greedy in terms of trading, trying to hang on to an unlikely, low probability likelihood is, stupid. It's a dumb thing to do. So getting into your trade, when it's coming down, you see a lot of weakness, and it's going sideways right at the 3.0 band, get out of your entire trade. Don't wait for your stop to get hit here at 95 when you can get out of this trade at 83, 85, 87. Don't give back 6 pips, or certainly don't give back 10 pips. It's a stupid thing to do. Now you can see the New Zealand also very, very weak on all time frames. So we want to sell the New Zealand yen too. Notice it dropped last night. If you shorted here, you maybe made a few pips, lost, shorted here at 39 when the trailing stop got hit, and it went down to 05. So you had a 30 pip win there. And I don't have the 3.0 bands on this one. Let me put them on. It looks like they might have went through them. Things happen. Even though something might be 80 to 85% probability, does not mean that it will never occur. So that's why we have tight stops, and when trades don't work, we get the hell out. So I have the 3.0 multiplier on there, and you can see in this case, it did go from 66 all the way down to 65.70. But one trade that I like to do myself is if I see it get in here, I might get into a trade. If it's going lower, I will draw my fibs off the last swing. And when it gets down to this area right here, I tend to scale in the trade. So I might, for example, and I'll do it in a very easy way, I might buy 1 lot here. If it comes down and stalls and doesn't hit the second one, I will add to it somewhere in between here. I might add 2 lots here. If it's a 2.0 level and it was real close to that, I might add 3 more lots. So I progressively scale down. That means I have 6 lots total. My average price is somewhere around here at 81, even though my last entry is somewhere down here. And when it shoots up, I tend to get out of those trades. A lot of times you get a double bottom. I'll start scaling again, maybe 2 or 3 lots down here, planning to scale in bigger the second time, and get out with a nice profit on the second trade. When it comes down again, I might start getting into a trade here to double bottom, scale in, and get out as it goes up. If you scale in, and you can use our tools to decide how you're going to scale in. You kind of, if you do it enough, you kind of learn what and how it works. Let's say, for example, you have a $2,000 account, and you want to risk. Well, in some of these scale-ins, you might put a 4% risk. Most of the time, new traders should use 1%. Experienced, profitable traders 2%. 4% for scale-ins at the maximum. Let's just say 25 pip stop, and you want to get in 1 lot. 2 lots and 3, and you might want to get in if it goes down 10 pips, and then 20 pips. So that means you're risking 5 pips on the third entry, and it will tell you how many lots to do to keep your risk at a certain amount. Obviously, if you have a bigger account, let's just say we have a $100,000 account, you can risk $4,000 on the trade. You're getting in 5 lots, 11.4 lots, and 17 lots. But what's nice about this is you've scaled in all the way down to 20 pips, and the average price moved down 13.34 pips. So from your last entry, if it only goes up 6.5 pips, you're out at break even. If it goes up 10 pips, you've made 4 pips on a big position. If it goes up 25, 30 pips, which a lot of times it does at these extremes, you have a huge position. You're very quickly within 6.5 pips back to break even. But only do this if you're an experienced trader. I don't usually teach this mainly because in the hands of a new trader that doesn't know what they're doing and does not obey their ultimate stop loss can get hammered and have their account wiped out on one trade. So be careful in doing this. But again, the pound was also strong, so you could buy the pound versus the Australian and the New Zealand. Let's put this on here, pound Australian. Look, just straight up all day long. And there's 2 entries that we have. One is the sideways, rectangle breakout, which you have right here. You want to get out the fib targets most of the time. That one only went up about 20, 25 pips. And then you want to wait for a pullback. You might consider this a pullback and went up a little bit. You probably wouldn't have lost more than 5 pips on that. And then the second trade, another pullback right here. And, it went from, let's just round up to 25, went all the way up to about 70. So it was a pretty big move, and the New Zealand was weaker than the Australian, so I expect to see more volatility in this one. This one kind of went sideways right here and broke out, went up about 50 pips. If you bought this little pullback, it went up, and it's at the 2.0 white band, so you really got to watch the real-time momentum. If you see strength on the way up, not much weakness, by the pullback, you might have lost 10 pips there. Sideways rectangle pattern for a couple hours, you get into that. You always want to draw your fibs on the last wave. And again, look where the market stalled. The first fib target, usually you want to get out of the whole thing at the second fib target here. And more than likely, I'll put the 3.0 bands on this to end today's class. More than likely, that's where the 3.0 bands were. So again, don't be greedy. If it hits the 3.0 band, which I like to label green to make sure I never miss it. Okay, so it didn't quite hit the band actually, but it was probably 5 or 10 pips away from it right there, the 1.618 fib target. All the time frame trends are up. Phenomenal trading, focusing on buying the strong ones versus the weak ones, and I will leave this up because this not only shows the historical real-time trend, it shows the percentage currencies above their 15-minute bars, moving average, hourly, and we have the daily, weekly, monthly trend underneath there. So on days like this, it's a no-brainer. These are the 3 that you buy. You want to sell the Australian and New Zealand, the Swiss, and to a lesser extent, the Euro.